Hello, Francois.
Hello, Mark. How are you?
Good, thank you. Thank you for joining us. Welcome back, everybody. The Americans are on holiday today for Washington Day. Is this a good moment for us to step back and look at our portfolios, especially the equity weighting? Now, when I spoke to you yesterday and we talked about what you wanted to discuss this morning, you said equity weightings in portfolios. Are you talking about US equities or European, or do you just think equity valuations are overstretched everywhere?
I think that you need to consider the total weight that you have in equities, which means that you need to consider emerging US or European equities. At the end of the day, after 6 weeks into 2025, the result on the stock market and the performance of the account, if you had a good exposure in equities, are quite satisfactory. And I think that it is the time to think about the idea, do I stick with my gun or do I reduce my equity exposure in the portfolio?
What do you think is a reasonable, for a balanced portfolio, what would be a reasonable exposure to equities?
I think that we enter 2025 to tell you to face the reality. We enter the 2025 with a slight overweight in equities. Considering the result that we experienced over the course of the last 6 weeks, the equity weight has increased a little bit. So I think that it's a good moment to consider to get back to what we consider a neutral level in equities for a balance account. For a balance account, it would be 45%. So it's reducing your holding from 50, close to 50, which is where they were before this decision, to 45% today.
The results of the non-big tech stocks has been extraordinarily good, though, for the last quarter that have just been announced. We're not finished yet, but there's still some to go. Does that encourage you in your thoughts that we should be rowing back on some of the big tech stocks and going into more valuation stocks?
I think you're right. There are different elements. The earnings season that is still underway but close to finish has been quite good in terms of the result that were announced by the companies. We mentioned that last week, 77% of the companies have beaten, so it was a strong result. Nevertheless, you had some sign on the guidance that there is more uncertainties, and I think this is something that you need to have in mind. When you look at the confidence of company lately, you have some gallops about the confidence about the future. Both the consumer and the business seems to be a little bit more worried. And to tell the truth, events in the course of the last 6 weeks, mainly over the last 4 weeks, I've told you that you are going to live with a lot of uncertainties in 2025. You know that I defend the scenario that more volatility is in front of us in terms of market developments. I think we can go through some elements that justify this position. I think that this notion that more volatility is going to happen has been reinforced by development lately. And I think this is the right moment to make a step back and to bring some cash out of the equity market, to increase your equity, your cash holdings. And it doesn't mean that I'm negative on equity for 25. Again, I repeat, I think that the equity can move higher, but I still think that you could have some consolidation in the very short term. So have some cash in your portfolio and you will seize opportunities in the future.
Now, the European markets have been playing catch up for the last few weeks, and in the face of not such good news as well. Does this encourage you to rebalance more towards European stocks?
I think that you need to decrease on both sides of the Atlantics. At the end of the day, the US market remains the leading market. If something is happening in the US, it's not going to let European without facing the consequences of such developments. But there is an element that is still in favor of Europe. The relative valuation is more attractive in Europe. On the one side, you have that positive element, the valuation. On the other, you still are under the spell of the leading market. So it means reduce both exposure.
Are there any sectors you would favor at the moment, particularly?
I think that you need to go more for defensive sectors that have the ability to resist if there is some negative development on the market in the very short term. So I still tend to like the healthcare sector. I still think that it's interesting. And this is the sector that you can build your position or that you should build your position into in the current circumstances. I think that be careful with the more cyclical sectors in the very short terms because maybe a lot of good news are priced in. So I think that it is more on the defensive side that you can find some opportunities.
The recent CPI numbers came out stubbornly high again. Does that reinforce your view that the next rate cut, you may think it still would be down, but that it would be pushed back a little bit further towards the end of the year?
I think that the numbers, the PPI and CPI number were quite poor. And you are perfectly right. And again, I didn't like the reaction of the market. The very short-term reaction of the market was to push yield higher, which is something that you should expect because those numbers were not good. And the market, the bond market, took advantage of some declaration about the Trump administration about tariffs, the story about reciprocal tariff, and etc. They consider that at the end of the day, it is a good news because it's not a general tariff policy that is going to be at play. And I think that you need to be careful with that because, yes, there won't be a general increase in tariff immediately because now the administration need to get back with some numbers in April. But nevertheless, look at what was decided. At the end of the day, it's opening the door to any kind of retaliation. It means that the US can take the opportunity. It can be the tax system, the VAT in Europe. It can be anything that can induce them to introduce tariff or reciprocal tariff. I think this is not necessarily a good news. The bond market rally on that news. I think it's not something very normal. And I still worry about the 10-year bond yield. I still believe that they are going to go back to 475 at least in the coming months. And to answer your question, I think yes, that the CPI number had really pushed the any possible rate cut by the Fed to the second half of this year.
The US dollar is down a couple of percent against the euro just over the space of last week. What's your take on that?
Again, this is something that is connected to the tariff development and the fact that the reciprocal tariff story has induced people to believe that I need less of a safe haven. It's also interesting to notice that gold has been a little bit under pressure by the end of last week. I still reckon that you need to be careful with this reciprocal tariff issue, that this is the market is pricing the best outcome of everything. And I think that you should be more cautious on your interpretation of what the US administration has in mind, in fact. So I still reckon that the US dollar is in a range of 1 to 105 against the euro for the coming months. I would not make too much out of it, of the late development. And I still believe that there is not a significant risk that you are going to get out of this range of 105, 10 against the euro.
Now, this morning, Japan announced remarkable GDP results for the fourth quarter that made most economists look quite stupid. It was expected at 1% year on year, and it came out 2.8%. Although the Nikkei has been flatlining for a year now. Is this should we start taking a look at the Japanese market, or is this just a blip?
I think that it's interesting. What you mentioned is very interesting. Be careful because that number can be revised quite significantly in the future. Nevertheless, there is something which is very interesting happening in Japan. In Japan, over the course of the last few months, due to the fact that the Bank of Japan is changing course in monetary policy, this is the only central bank, developed central bank, who is raising interest rates. And it has an impact. Clearly, the behavior of the yield curve is changing. The long-term bond yield have increased quite a lot. So you are back into a kind of normal development for the yield curve in Japan. What does it mean? It means that finally investors are convinced that the central bank and Japan have been able to destroy deflation. And 10 years, 20 years, deflation was the main issue in Japan. So this is something that is quite positive for the equity market in general, I think, because it tells you that growth is back for the medium term, that the deflation threat is disappearing, and that's something that could support movement towards Japan in the course of the coming months.
A couple of very important events coming this week, in fact, and into the middle of next week. So German elections on Sunday, and Nvidia announcing their results next Wednesday in 10 days' time, not this Wednesday. I'm not sure which of those is more important to the markets at the moment. What's your take on the possible results of the German elections?
I think that they are very, very important election result to watch. The main reason being that you have the extreme right party and the extreme left party gaining lately. So it means that you need to see the consequence. Which kind of coalition can the German government build? And you need to also put that into perspective. Over the weekend, and we all know what happened in Munich and the kind of stupor that European faced with the declaration of GD Vance in front of them. It's very interesting to notice that Mrs. von der Leyen came out with the idea that they could reduce the pressure on the deficit front from European government in order to be able to finance the military spending that Europe will need. It's a very, very interesting development, and you need to put that in light with the German election. Because depending on the result of the German election, this kind of proposal is subject to the possibility of becoming a reality or not. Because if the coalition doesn't want to change the fiscal rule, doesn't want to change the stability pact and etc., then you could have an issue. So it's a very, very important development. The German election to me is a key issue. This is also one of the reasons I consider that it's the right time to reduce your equity exposure in your portfolio.
Surely the AfD, if they do obtain more influence in the future government, wouldn't they be pushing for a relaxation of the deficit rules in Germany?
The CDU and the SPD, but you always wonder, Mr. Scholz, who was in power for 4 years, has not even considered reducing the impact of these, deficit break, the break, and now suddenly is in favor of that. It's mainly the CDU and Mr. Merz who is also in favor of changing course on that. AfD, to my point of view, is not that important in this regard, because I don't think that they will be part of any coalition in Germany. If there is a coalition, what looms is a two-party coalition between CDU and SPD, which would be, at the end of the day, under the rule of the CDU, a good outcome. But then if you have to deal with other parties, the Green and the Liberal Party, then it's a different matter. Because if those parties plus the extreme parties make too much, it means that you need to build a coalition on more parties. So it's more difficult to find a consensus. This is the big risk.
Coming now to luxury, I keep seeing alarming reports about very rich consumers pushing back against very rich goods and not so rich quality. Is this something that concerns you? Is this a big change in the luxury market?
The result of Hermes last week told you that this idea is not necessarily the right one, because very wealthy clients have brought the result of Hermes to a level that was absolutely unexpected. I think that the high end of the luxury segment is still very in demand. The problem is that it's the companies which produce quote unquote pseudo luxury goods, because this is where you have the problem, is the fact that, the necessity for people to purchase goods that are supposed to be luxury because it is showing that you can access those goods is maybe something that is not maybe, something that is under threat currently, because people have realized that because of the increase in prices of those goods, that it's not necessarily worth paying the price of such a good for the quality that they are. And at the end, it does not produce you a lot of satisfaction. So this is more the middle segment of the luxury business that is under threat, not so much the high end. Hermes is an example. Look at what happened with Richemont and the jewelry, what happened there, what happened with the jewelry business at Louis Vuitton. You can see that ultra wealthy and super wealthy people are still consuming very luxury goods.
Francois, that's all we've got time for. Thank you very much indeed, and speak to you next Monday.
Bye-bye.
Bye-bye.